Today, we're here with Ronnie Söderman, seasoned professional with more than 2 decades of experience for systematic, learning-based asset management. He has a PhD in finance and a master's degree in computational finance, and is one of the co-founders of Geneo Capital, which specializes in quantitative asset management across multiple asset classes. Ronnie, thanks so much for joining us today.
Yeah, thank you. Thanks for having me. It's a pleasure.
Absolutely. Why don't you start by, let's start off with the fun question. Talk to us about football. What's your favorite team?
Yeah, football. It's a funny thing. I mean, in Finland and in Scandinavia, actually, we grew up in the 80s and 90s. We were always treated with English football. There was always a game on Saturdays. So that was sort of the highlight of the week. It was always just one game. Of course, English football came to be very close to the heart. For whatever historical reasons, I ended up supporting Newcastle United. Not quite sure why. It was me and my cousin. Somehow we ended up supporting that team many years ago. And it's been, it's been a rough ride. The 90s were nice. Early 2000s was decent, but then it was like 10, 15, 20 years of pay. And now it's starting to look a little bit better again. But besides that, I'm trying to pass it on to my kids, so I do apologize to them in advance. I mean, it's a rough ride, but it's fun. I mean, as always, of course, all your friends, everybody that they always support, the big teams, Manchester United, the Liverpools, and whatnot, Chelsea, Manchester City, of course, in recent years. But on the other hand, I mean, Newcastle United, they do have a decent following in Finland as well. So you're not completely alone, but it's I guess it's mainly due to the success or some success that they had in the 90s. But let's see. Locally in Finland, of course, football is it's on the up. I would say it's a huge sport. We have ice hockey, obviously, which is number one sport in Finland. All the talented kids tend to go for that, especially the big and strong ones, which of course have good attributes to have in football as well. So we got some catching up to do. Of course, we also have the handicap of half of the year we spend time in a pile of snow, so it doesn't really help when you want to practice football. But of course, today you got this artificial pitches everywhere, heated pitches, indoor pitches. So it's getting better. The national team has had some minor successes as well. So hopefully, I mean, in the future we'll see a little bit more success on that side as well. But it's mainly English football, of course. That's close to the heart. Well, I guess for all Scandinavians in general.
That's great. It's exciting. Yeah. Very cool.
Awesome. Why don't you tell us a little bit about Genio Capital? What are you guys working on these days? Just give us kind of, high level overview and, what you guys are up to.
Yeah, happy to do that. So we started, I mean, it was me and my colleague Marcus. We've been in the business since, the early mid 90s, close to 30 years. So we decided to set up Geno Capital in 2016. Basically, the idea was to bring something slightly different to the financial industry rather than be, the traditional one company, one fund, or one company, one product kind of outfit. We sort of built and pioneered a very standardized systematic investment process. This process, we basically thought that we can apply to pretty much anything out there. So we saw sort of the benefits of launching that in a investment management environment. So we set up shop in 16 with the idea then, of course, to provide adaptive learning-based investment strategies across all asset classes. We had a background in the managed future space on the traditional side, so trend following, macro intraday test trading and things like that. So it was very natural to sort of apply this investment process first to the sort of the trend following for the macro world, to just create a proof of concept, because obviously we built an approach where we can pretty much create anything that the investor wants. You cannot really go to an investor and say that, hey, they do whatever you want, and then say, okay, fine, there's the door. So you need to have something to show for it, something where you can prove that sort of the approach works, and that what you're doing. So we launched sort of what is now the flagship systematic macro program. Then back in late 16, I think it was, we got the first managed accounts early 17, and we've been running that ever since. But all them since start their slowly whilst building the track record, we try to sort of bring this idea of quant as a service then to investors as well. That we have the platform, we have a standardized platform where we break down the investment world or the financial markets into 2 layers. And at the bottom layer where you focus on different behaviors, and the top layer that then allocates to these components. And the idea is, of course, that everything is standardized. The components are standardized, so no matter what comes in, what comes out is in the same form as everything else. So this means that we can easily combine these into different strategies and programs, depending on what the client or the investor wants. So since launching this, then we tried, like mentioned, we tried to bring this as a service a little bit to the table. So instead of people building their own quant desks and stuff like that, we can easily outsource it to us, because we can manage it with the platform and systems that we have. So we're very happy that today we have one client on that side as well, and long-biased equity fund that we're running for another hedge fund. So it's the same algorithms running that as well. And then obviously, I think it was 3 years ago now, more or less, we then took sort of the platform and the approach as well, and applied it to the crypto world. Of course, maybe more from the shorter end of the trading cycle. And so we've been running a prop account and managing a few million for an institution there as well for close to 3 years now. So it's basically the idea is that we have something that's very flexible, very standardized, not only the investment process, but of course the execution and everything as well. And no matter, for us, it doesn't matter if it's the traditional future space with equities or if it's the digital space, it all looks the same. It's the same platform, the same algorithms, the same approach. So it's very scalable, the way we work. At the end of the day, it doesn't really matter to us if it's a managed account, if it's a fund, or if it's a fund in somebody else's name, or if it's band name. For us, it's just an account in the system, and we plug in the components we need, turn on the allocation algorithm, and off it goes. So it's very scalable, and we're very happy with it. So we are sort of trying now to answer the question, what we're up to these days. So basically, we are now then trying to leverage the approach, trying to bring in more AUM, obviously try to grow it a little bit. We start to have quite a decent track record in terms of length, especially on the traditional side, but also the digital side, approaching 3 years. I think that gives it quite a lot of credibility. So we're seeing quite some interest there as well. Obviously now with what's happening in the crypto markets, with the heavy bull run that we're seeing, so naturally brings a lot of interest again. So we'll see if something materializes on that. We're in the process of setting up a Cayman fund as well, together with a partner that we work with on the traditional side. So hopefully we'll have that up and running sooner rather than later. But it's been a long and winding road. Of course, the landscape tends to change a little bit all the time as well, so it doesn't really make it any easier. And then maybe I think if you say 1 or 2 years ago, I think especially so the investors, the family offices from the traditional side, when they sort of started looking into the digital or the crypto space, the demand or they always ask for funds. And now I think we're seeing a little bit of a change in that people are more and more ready and willing to accept, SMAs, managed accounts. It almost seems to be the preferred way nowadays. I think it partly goes with that as well, that the exchanges have become, big and sort of they feel maybe a bit more secure, and people are getting used to them, and they see the benefits of only having to post a little bit of margin or keep it in a home wallet, and of course you can use custody services as well. So it seems to be something that we are seeing a little bit of an increase in interest on that side, which of course is fine by us, because on the traditional side of school, the majority of the clients they want SMAs and it's efficient use of capital. So it's something that we're very well familiar with, and we can both on the traditional and on the digital side, we get hooked up with pretty much any broker or exchange. So it's interesting times, definitely, and a lot going on. So it's and Genio Capital obviously is quite a small player. We try to consider ourselves as an emerging manager still today. We're only 4 people on the investment side. We manage around $200 million USD at the moment. Hopefully, then, like I said, hopefully that will grow a little bit going into 2025. Everything then, of course, around the company, the back office, reconciliation, and compliance, all that is outsourced. So we don't have to worry about all the boring parts. So I think we work very well together, and of course the whole, what facilitates this is of course the platform. The way we work, since everything's standardized, everybody works on the same platform. So the scalability it brings, I mean, that really means that we don't have to be 50 PhDs to do what we do. It's quite the opposite. I mean, it's we get to spend our days anyways on trying to improve things, improve the system, find new factors, new behaviors, target, find new methodologies. But I mean, the systems, the strategies, they run themselves on a daily basis. We don't really have to waste too much time on that.
Yeah, that makes sense. That's interesting. You mentioned that the SMA is kind of, people are okay with that format, which is great. Obviously, you're used to that space, and from a managed futures perspective, obviously having a program, SMAs are definitely the popular way to go.
Yeah. It's when we started out in 2016 as well. Of course, we set up a fund, and we were looking to to raise money for a fund and so on. But we pretty soon realized that everybody wants a managed account, and that fund is still around, and we do have investors in it. But it's interesting the way it works. But and then of course with these professional family offices especially, I mean, it's like said, it's such an efficient use of capital when they can do the cross netting as well. And I think, talking to the crypto exchanges today as well, we talked to another one of the big ones, just the other day as well. And of course, every single one of them, they offer these kinds of SMA system structures, account and sub accounts as well. So it makes it for any half professional family office or even high net worth individuals and all the other guys out there as well. I mean, it makes it so easy. If you want to deploy capital to several strategies, several managers, it seems to be quite straightforward nowadays, which is nice. I do think that we will see even more money coming through that pipeline going forward, if anything.
Yeah, and actually, it's interesting. And for those watching, SMA separately managed accounts. But Ronnie, talk to us about what are you seeing from investors? Do they prefer to invest in that separate? And this is crypto as well as even the traditional market. So what are you seeing today? Do they prefer the SMA approach over the fund aspect?
Yeah, definitely. I think like mentioned, I think we're definitely seeing on the traditional side, it feels like I said that it's always been that way, at least over the last 3, 4, 5 years. It was definitely a push towards that one. We don't hear anybody talking about wanting to use its funders or everything. It's always maybe the big institutions, the pension funds and the pension schemes and the plans. So they maybe do not necessarily do SMAs, but especially the clients that are attracted to us in the mid space that can do any smaller tickets as well. They always tend to prefer that over funds, and of course it's natural. I think costs overall are of course smaller, and then just the speed or the turnaround of setting things up, and then of course they have total control to the positions live basically or on any frequency they want because it's their account. So and then of course it's margining and as well. So on the traditional side, I think it was maybe even a slight surprise, and the demand was so strong. And like mentioned on the digital side, I think we're slowly getting there. I mean, in a way, maybe the surprise is slightly bigger here, but because, like I said, a year or so ago, I would say that everybody wanted to fund. Very few would be able or even willing to do an SMA because they didn't feel comfortable just posting any kind of margin on any of the exchanges. I guess probably due to FTX and what happened there, because before that it felt like the momentum was really going, but then that sort of pulled the plug. I think for a lot of family offices especially.
Definitely.
And so the more traditional investors that were slowly getting in there, so it felt like they all hit the brakes and disappeared for a year or so. But now it seems that some of the exchanges, obviously they are regulated, and the bigger ones as well, they've been around for some time, and like I said, they have this account structure and everything more or less ready, and especially with the introductions of the cold wallets and being able to mirror the margin towards the exchange and all these kinds of things make it makes the people or investors feel a little bit safer to also do sort of a managed account kind of thing. And for us as well, I mean, forget it. If anything, we're very happy with that because it is expensive running a fund, and especially at least before you hit any decent kind of size, it's such an efficient approach with the managed accounts, and especially on the crypto side as well. Since maybe on the traditional side, what the benefit of a fund is, of course, that the minimum size invested can be a little bit smaller because obviously you're buying shares in a fund, whereas in a managed account, you need to post at least, you need to have some sort of minimum investment to be able to, to actually invest in the full size of some of the bigger contracts out there. Whereas, of course, on the crypto side, as we know, you can always trade fractions. So it means any managed account or anything can be, from $10,000 and upwards, basically. Of course, maybe there's no point in doing those small ones, but the tracking error is really, really, really small. So that's obviously another good feature of the digital market, or something that's very, very interesting.
Yeah, well, actually, that's a great point. Maybe get into the specifics, Ronnie, about for folks who don't know what the crypto futures markets look like compared to the traditional futures. What are some nuances there? Where's the opportunity? What are things to look out for, as you mentioned?
Yeah, maybe to take one step back. So maybe just to actually clarify and say why we chose to do futures in the first place. So when we ventured in sort of to the digital space many years ago and started looking at it, and actually then we applied 3 years ago, and the idea was, of course, that since we had investors on the traditional side, and we were doing sort of momentum trend following in the traditional future space, we thought that, okay, if we want to do something on the digital side, then we'll do, sort of like a similar type of strategy, really to sort of bridge the gap between the two worlds and maybe make it really easy for our current investors to go and invest in that side. So that's why well, of course, there are other benefits as well with the crypto futures, but let's get back to that. But that's sort of the main reason why we decided to do, perpetual futures instead of spot. Of course, going long, going short is much easier because you do not have to borrow anything and some financing costs, obviously, but still, in terms of the margins as well, naturally, when you trade futures, then you only cost the margin. And another benefit, of course, which is quite fascinating for me from the traditional side, where it's the broker or the exchange rather that sets the margin, how much you need to post for holding a specific position. So basically, in the crypto futures markets, you can decide your margining yourself by sort of selecting the leverage you want to use when you go into a position, or when you purchase the contract. And obviously, you will be stopped out automatically then if the margin is wiped out. So there's no point in maybe using 100 times leverage every time you trade. But so there was some new features, of course, that we have to take into consideration. But yeah, so we went into sort of the future side, starting to look at the futures that were available in terms of liquidity, and then starting to trade. Of course, there's a lot of volatility in our trades every now and then. Of course, we've seen quite a few ranging markets as well that are quite difficult in terms, especially the volatile ones. But yeah, we then trade sort of a momentum chasing short-term trend following program, that where the average holding period is about 1 week. I would say maybe slightly longer in terms of good trends, but typically it's quite quick to react and adjust. And the main benefits, of course, with the futures market are these that well, first of all, compared to the traditional side, you want to buy a Brent crude futures contract, well, you have to buy at least the one, and it has contract size of 1,000, and it requires a little bit of money to be able even to buy one contract. Obviously, in the Nasdaq and S&P futures, and many else, there are the mini and micro contracts, but they're still quite big. So it means that if you want to set up a managed account to trade any kind of, managed futures program, you still need to cost 1, 2, 3 million for it to make sense. We're not, to start
Size-wise,
yeah, size-wise, not to get that tracking error, towards the benchmark program, so to speak. And these are the things, of course, like that you don't really see on the crypto side, because you can trade, well, obviously 0.0001 Binance futures, right, if you want, and so on. So it's really convenient. Liquidity is obviously the other thing, maybe that's priced us a little bit, at least.
Yeah, what do you see in liquidity?
The markets, if you look at the market microstructure, I come from in the early 90s. I started as an options market maker on the Frankfurt derivatives exchange. So I'm quite used to looking at, examining and looking at, the depth of the books and so on, and trading based on those things as well. Of course, now naturally we do a little bit longer term holding it, but still it comes quite natural. And I think it was that was probably one of the things that maybe surprised me the most. I mean, if you look, now we trade the 30 most liquid futures, for instance, on the Binance Exchange, so we trade the 30 most liquid and biggest in terms of market cap, basically. Every single one is, I mean, it's amazing, the size of or the depth of the book, the bid-ask spread, how small it is, and so on and so forth. Of course, I mean, we do realize that it always looks good in a normal market, and then of course something might happen and the liquidity goes away, and so on and so forth. But that happens on the traditional side as well. So there's really not that big of a difference. And I would say on the traditional side, even though been around the futures markets, they've been around forever. I mean, if you go past the 40, 50, 60 biggest futures markets, you might start actually to run into liquidity issues. So, and it doesn't be the case maybe on the crypto side yet. But of course, I mean, we are not that big. We manage a few million on that side, so it's the business as of yet. But so far, I mean, in terms of liquidity, in terms of getting executed, in terms of the implementation shortfall, tracking the slippage and everything, it's been really, really nice and positive surprise. So I'm quite confident that capacity in the strategy is good. This is obviously, I mean, the final point is, but why, another one as well, why we chose sort of to do trend following instead of, I think the majority or a lot of funds, obviously, they do the cross exchange arbitrage, and you do some basis arbitrage, and you do calendar spreads, and there are a lot of different arbitrages that you can do, especially now as maybe the markets are still young. So there are a lot of opportunities. But of course, if you want to do an SMA, it becomes a little bit cumbersome, because basically then the investor has to open up an account and everything, applications, so on. So we decided that no, we don't want to do that. We want to be single exchange driven. Then the investor can say, okay, I want you to trade the strategy for me on Kraken or Binance or OKX, and then they're fine to do that. So they just need to post the margin and give us the API key and the risk trading. So that was the other reason why we sort of wanted to keep it as simple as possible. Again, to sort of get those
setup, easy for taxes, cost efficient.
That too. And of course, again, like mentioned at the beginning, that to get traditional investors sort of comfortable with it, to make it the leap from the traditional to the new world as small as possible, if you want. So that was the other reason. And then, of course, maybe the final reason then, of course, is as well that whereas all the arbitrage strategies, yes, they usually have small drawdowns and nice Stark ratios, but the negative thing is typically then, of course, the capacity. I mean, there's always so much money you can put in any arbitrage strategy before it goes away. So, of course, momentum chasing, of course, yes, the bigger you get, the more slippage or implementation shortfall you might probably, or you will probably counter depending on your execution on those. But still, capacity is really, really good that compared to traditional one. So we wanted to build something that is sort of institutional grade from day one. So if somebody goes and says, hey, there's 100 million, manage it, then it should be it.
Yeah, that's great. Appreciate the details too. It's a lot of interesting stuff there. Talk to us about trend following strategies. What do you kind of how do you guys operate? How do you think about trend following strategies?
Yeah, it's an interesting one. Like I said, I mean, we have me and my partners, we at Geno Capital, we have quite a long background. We used to work for a CPA back in the 90s as well. So, we see in all the ups and downs and all the challenges with traditional trend following. And of course, the classic one is this curse of convexity, which of course means that if you're trend following, you typically have your biggest exposures at the end of the trend. I mean, that's just the way it goes. So I think a lot of our time when we set up Geneo Capital and we set up this investment process, breaking it down into 2 layers and focusing on behaviors and trying to get sort of this 360-degree view of the market. And I mean, everything we do is learning based. I mean, basically, you could say that we were doing AI before it was fashionable. We didn't talk about it much then, and we still don't talk about it much today, because it's one of those things that comes and goes as any other buzzword. It was ESG, and of course, I mean, AI is here to stay, and machine learning is here to stay, and everything just gets more efficient and better. But I mean, that is what we do. So for us, it's just everyday business. So we sort of wanted to take this approach that we have really get this 360-degree view and apply it to sort of the trend following space. And that's how we came up with the sort of the flagship program that I mentioned at the beginning, this systematic macro program that we have. So we we try to, in general, capture the general trends that are there in the market, but we try to do it slightly differently from everybody else. We try to be a little bit quicker getting in, but then especially then a little bit quicker getting out. And I think the secret behind this is exactly this, that we don't go only, if you're a traditional trend follower, if you build a position in the S&P, for instance, then you tend to look, okay, how is the S&P doing, or maybe different time intervals backwards. Whereas we then tend to look at, okay, of course, how is the S&P doing? How is it expected? How is it expected to do going forward? But we also try to get that, second dimension where we look at, okay, how is the S&P doing compared to, NASDAQ? How is it doing compared to Europe or Far East Asia or some other markets? And we utilize that information in building the positions. But then also we have what we call sort of the third dimension, which we call basket models, but which is basically that we go, across asset classes and across time, and really try to get that sort of non-linear relationships and that exist between the markets. So if we build a position in the S&P, and we don't only look at S&P or the equity markets, but we also look at the bond market, the commodities, the currencies, and all these together, to try to get a very strong signal to noise, and that typically then helps us to some extent, hopefully then spot all the dislocates to the different markets and maybe get out of the market a little bit quicker and get in the market then when things start to form. Because nowadays, of course, the financial markets, they are so efficient, they are so co-integrated, everything moves together, especially, in times of, in times of volatility or in times of crisis, then everything has to, which is of course a bad thing, because a traditional trend follower probably trades hundreds of markets public, and I said, okay, that brings a lot of diversification, which is fine, but then when things go south, then everything correlates anyway, so it doesn't really help at the end of the day. So this is something that we work very hard on. So as well to solve those issues and finding those key drivers, that and just a handful of them there, and try to combat these things, looking at the tail hit ratios and diversification ratios and things like that. So it becomes a very a very adaptive approach. So we trade quite a concentrated portfolio. So we diversify instead in terms of, looking at several factors, not only the momentum factor, but there are several factors included, several models, trying to get that information and piece it together. So the total cumulative position in any program we run on the traditional side or in the crypto side, it's always, the end result of these different views of the different subcomponents and the allocation layer altogether. So it becomes a very, flexible, responsive approach to trend following, if anything. And like I said, it's very much learning based. So we try, to recreate from using the very simple stuff. Rather than bringing simple models to complex markets, we try to bring them a bit more complex market, or complex models to what we call simple markets instead. So reducing the number of markets, being a bit more responsible, a bit more clever. Obviously, we could never compete with the big guys out there that manage billions and billions and, have the 3,000 employees. So we have to, find our own niche, try to be, slightly different. We think that the approach and the progress that we have in general, especially with the investment process and the platform that we built, it helps us to be slightly different. So of course, it's always via the correlations to benchmark APIs that we then try to add value to the investor. So typically on the traditional side, the where we bring value to the big clients is that we usually fit quite well in sort of the CPI and macro buckets, but we diversify it quite nicely since we tend not to over correlate with everybody else. Especially, I think when traditional trend following is suffering, then we tend to do fairly well and so on. And that's of course due to this approach that we run. It's a little bit same on the digital side as well. So far from what, of course, always, momentum trend following, the Sharper ratios are always lower than the traditional, and also the traditional arbitrage and these kind of strategies. But having a Sharper around 1, I think it's quite decent in terms of, and then picturing those mid-term trends, and of course, where the value we bring there, especially on the digital side, I would say that it's always a constant volatility, and the drawdown is then of course much reduced compared to long only strategies, obviously. And I think in the beginning when we started out in 21, or 21, 22, whenever it was by, I think a lot of the competition as well, there was probably maybe some from the traditional side venturing over to the digital space. I think a lot of the plans and the strategies that existed sort of just started in the digital space. And I think it was quite evident that a lot of these, they had a long bias. So it worked very well when the markets are bullish, but then when we get the bear market a few years ago, then we saw quite a lot of spike in interest in our approach then as well, because I think we were 40% up that year as well when the market went down. So of course, the edge or what we try to bring is, of course, that we don't really correlate the underlying theme. Well, the Bitcoin in this case, the correlation is literally there on the zero as well, which is of course the way it should be. So again, if you consider yourself be just a digital investor, then of course we do diversify that exposure, then might have it quite nicely. But of course, if you have a well diversified, if you're a multi-manager kind of outfit as well, I mean, then of course investing in something like the crypto strategy, I mean, also brings features, because obviously it doesn't correlate with anything on that side either. So it's quite fascinating. It's slightly negatively correlated to almost everything. So for any professional investor, I think, I think over the next 1-2 years, we'll be surprised if we don't see a big spike in interest. I think the big multi-managers out there as well, because of course, obviously they're searching. There's a huge competition for talent. There's a huge competition for alpha, especially uncorrelated stuff. So sooner or later, I think one or two of them have already ventured into this space. But I think more will follow.
The correlations. Why is it so important for these investors to have negatively or less correlated assets in their portfolio?
And there's an old saying in the financial or the quant industry that diversification is the old free lunch. And I think that is something that I always try to have as my mantra. It's something I believe in quite a lot, because obviously today, I mean, there's still a limited investable universe. There are only so many instruments, there are only so many strategies you can trade in, and everything tends to correlate to a certain extent. So it means that if you have a big enough portfolio that you need to invest, the key that you're always looking for is diversification, which obviously means that the new manager, the new strategy, the new program, or the new instrument that you want to invest in, you want it to correlate as little as possible with what you already. So that's of course why this correlation aspect becomes so important, because then obviously on a portfolio level, it means that you will have reduced volatility, you will reduce your drawdown typically, and of course increase your Sharpe. Of course, sometimes, if you're able to use leverage then as well, then it also of course means that you can boost up your overall investment in that, because you're so much more confident in the strategy or the portfolio that you are managing. So that's why of course the correlation becomes key. I mean, even if you take our program on the systematic macro side, I mean, we run about 22 different submodels in there at the bottom, and you can already say that whenever we come up with a new factor, or whenever we come up with a new model that we want to introduce sort of into the mix, I mean, we don't even have to look at the Sharpe ratio of that individual strategy anymore, because it doesn't matter. If it has a high Sharpe ratio, it will most likely correlate with something in there anyway. So if we introduce it to the portfolio, it will have no effect. So it always becomes the other extreme, but that as long as it's positive but negatively correlated, then you'll introduce with the portfolio. So it's correlation is important for a well diversified portfolio, and obviously the more diversified it gets, the more inflation costs.
You mentioned you have 22 submodels. Talk to us about kind of what is a submodel, and how do you guys think about these? Do they kind of work together? Do they, are you mixing multiple of them, or kind of just give us the high level of those?
That's a good question. It's always typically when we talk about a submodel, it's a learning-based component that then targets a specific behavior that we have to notice in the markets. One model then, for instance, one submodel could, for instance, be just simple momentum chasing model that we see that on a specific time frame there seems to be a momentum factor that we want to capture. And then that same submodel, it can trade, anything from a few markets to quite many markets, then where we observe sort of the same kind of behavior, the same kind of factor. And then of course the submodel on its own, it will always, whenever it enters into position, every submodel, there always, the target probabilities on a model level, but also on the individual instrument level that they trade. And whenever it enters into position, there's always stop losses with the targets. There's always, the sizing is always depending on, the level of confidence in the signal, the strength of the signal, basically the expected holding period, the realized volatility and the expected volatility. So there are a lot of things going into the process when you start to build that submodel and just build that position. Then of course, it's always a fine line then that's if you have a slightly, correlated or slightly related similar kind of momentum chasing model, that we split it into a separate model. And typically that line, where we draw the line is not always straightforward, but we sort of have our systematic process there as well, sort of the tick boxes that we follow. So the idea, the phenomenon, the factor needs to be slightly different. There needs to be slightly different logic or slightly different modeling approach to it. If you use one kind of machine learning approach, maybe use something else on a slightly different time scale to do something slightly different. So typically we have different kinds of tests and the characteristics that we look for, where we split those models, because at the end of the day, like briefly mentioned at the beginning, we want, no matter what the information that comes into the model, if it's sort of a directional one or if it's a relative value or if it's a basket model, we want the output of that model to be very, very standardized, which means that we can combine them at the allocation layer, then has much easier job in building or allocating the risk and building a portfolio. So that's naturally why as well, when we talk about submodels, that we try to find those submodels, those things, factors, then that again don't correlate too much with what we already have there. Naturally, of course, I mentioned the three different dimensions that we work with. So the first dimension where you just look at the S&P in isolation, and then you got the second dimension where you look, S&P versus something else in closely related or correlated, and then the third dimension, the basket model. So then, of course, that's one of the first things that we establish when we discover a factor where we have an idea, something that we want to test and build a submodel on. So that's sort of the first step. Okay, is it a directional, is it a spread, or is it a basket model? What is the approach, the methodology? So then it becomes quite natural, and then what are the instruments that we need, and then of course all the features, all the traditional stuff, the sizing, risk management, cash management, all the things they are built in accounts, sort of plug and play fashion. So it becomes quite easy for us to back test and evaluate different components and see. And then sometimes, it could actually be the case that we notice that we build a new submodel, but we realize when we enter sort of if it passes the first test that we have in terms of performance and risk and so on. There's a dozen or so, a few dozen probably different metrics that we look at, some proprietary and then for the normal stuff as well. And if the submodel sort of passes that first step, then it's always the portfolio fit, which is the next step. And then of course we have a library. If 20 or so models are live, you probably have a library about another 20 30 models that we're sort of tracking, that are always paper trading and that are sort of in an evaluation phase. So there's a decent sample to compare the new model against, and it happens from time to time that we find that we really like this approach, we really like this idea, but it correlates quite a lot with something that we already have in there, or something else that we are monitoring. And so then there's always this opportunity of combining those two ideas, and then combining it into a new submodel, so to speak. But there's always this trade-off of having grouping too much together, because then of course the allocation, if within that submodel, then if something works and something doesn't, then it sort of cancels each other out. And this is the thing that we want to get rid of, because if something works or something doesn't, then we want the allocation algorithm to be able to allocate to the stuff that works and not allocate to the things that don't work. So those are the things. But I think we become pretty good at seeing where to draw the line. But of course, in this business, I mean, you're never fully learned. So you never get anything finished. It's always, it's an ongoing process of improving things, learning new things. And, with all the COVID and now this incredible inflation environment that we saw the last few years as well, I mean, it's something that, we haven't seen them since the 70s or something. Yeah. Of course, it's not easy to get decent data for that period. Even the markets will not be around, I would say, in any liquid percent, or in terms of liquidity, at least there was nothing to come, or they weren't good enough at that time point. So there's a lot you can learn from these things. And as a fund, of course, you don't want to see those crises. You don't want to see events like the COVID, but it's such an intriguing and new normal that you also are exposed to. And it gives you so much new information that you can test on and that you can build on. And I think we learned a lot from that experience as well. We sort of saw in the information matrix where we need to improve and where we were sort of lagging. And again, we prove of this, that no matter how well diversified you try to be, when something extreme like this happens, then everything correlates all of this. Anyways, there was a huge sell-off of everything. I mean, it was, and nothing worked basically in terms of the slightly longer term stuff. But then on the other hand, I think if we talk about COVID, the March events back in the day, I mean, I think after that, I think we saw 6 or 7 positive months in a row. So this sort of adaptive process was quite okay. Of course, it was helped by the central banks, everybody stepping in and doing their thing, of course, staying in the markets and whatnot. But all the things that followed, I think the adaptive approach that we had, it was quite quick in picking up upon that. So that is something we're very happy with, even though the crash itself was not that great. I mean, okay, we didn't lose a lot of money, but we were still negative. But then on the flip side as well, if you want to be a little bit critical, which I think you should always be, what's your own approach as well. I mean, over the last few years, when we've seen this really strange high inflation environment, like Blunt mentioned, we've also seen that some of these models that we trade, or this, especially, the third dimension, the basket models, trying to find those cross-asset relationships and everything. And there's been such a low degree of conviction in the market or in the models, in the signals. There's been a very limited opportunity set for the approach that we have. So we've seen a little bit of a fall of volatility, which has been annoying, of course. But this is the way the program and the investment process was designed. If there are no good opportunities, we don't want to keep banging our heads against the wall and just trading for the sake of trading. Then it's better to scale down. I mean, the traditional trend follower, again, on the flip side, it's always in the market. It's always going short, doing something. And of course, in a ranging market, that's very seldom a good idea. So that's why we build this investment process the way we did. That be restrictive. If you don't believe in the market, then calm down a little bit. So in the say individual submodel level, there has been quite a low degree of conviction, and even on the allocation layer, we've seen cases where it's been very careful in distributing that risk and the models utilizing the risk. So it's been an interesting environment. So that's of course something again that we've been working very hard with, trying to find, models, approaches, factors that are, prevailing in these environments as well, that can bring us that, volatility, something again to really, for the models or the allocation layer to be able to allocate in these interesting times, so to speak, because that's the challenge maybe on the traditional side, is that the cycles are still fairly long, and it's a bit slow, which means that it makes it a little bit difficult maybe to target the volatility as well, as compared again on the digital side. I mean, everything that takes 6 months to happen on the traditional side, it probably happens in 6 days on the digital side. So there's such a big turnover in turn of the positions and the trends and the ranges. So that, of course, on the flip side, it makes it much easier to keep that target volatility because there's something happening all the time. So or as one and as a systematic trader, it's almost, it is easier because you got so much to work with, so to speak. On the traditional side, when nothing makes sense, then it slows down, and then volatility falls, and even though you're still able to squeeze maybe some decent returns out of that volatility, it's still frustrating. But we are seeing signs that it will turn. And I think now where we get Trump in the office and we get that uncertainty behind us, of course, it brings a lot of different uncertainties, probably. But still, I think it's that the markets will know that hopefully there will be a little bit more consensus in the markets to see those trends that we can pick up upon there as well. It's definitely very interesting times.
Yeah, for sure. Definitely. And you mentioned something earlier, right, which I was going to ask about, which was you set up your company, your firm, from an institutional infrastructure perspective early on, right? I'm just curious, the types of investors you're seeing, is it all types, or do you have a specific focus? I'm just curious, what does that look like for you?
Yeah, that's a good question. So it's quite true that we set up very institutional grade from day one. Obviously, you have one platform that we use in research and in execution. So it becomes when we are in those operational due diligences, we typically get quite good feedback because it's quite solid. We work, of course, with the brokers and the top names in the business as well, depending on, of course, what the investors want. But definitely for us to target are, institutional investors. We don't really have retail investors as such. We don't really have a path for them as well, I would say. So we target those professional investors that, have a diversified portfolio where we can bring, again, that low correlation, hopefully help them diversify. So, and that's, of course, we are, I forgot to mention that we're Helsinki based, the investment team, but Geno Capital is actually registered and licensed in the UK. So we try to keep from day one also a very international profile. So the majority of our customers in terms of numbers are from continental Europe and from the US. And of course we have one or two in the Scandinavia as well, but we try to keep a very international profile, and the typical investor is a family office, a fund of funds, or an institution that typically are all already invested in some of these kinds of programs. And on the digital side as well, I mean, it's definitely the same. We have many at the moment, but there I would maybe expect, say, the high net worth individuals to be a little bit more, frequent as an investor compared to maybe on the traditional side, because there are worthwhile people as well that have just gotten wealthy in that space and they are used to that space, and not many of them maybe are sort of traditional family offices yet and so on. So we're seeing a little bit more interest from that side there as well. But definitely, I would say maybe the family offices or fund of funds are the traditional people that we are talking to. Maybe one of the things that surprised me quite a lot talking about the digital side or the crypto side is that the Swiss family offices would be so interested, that sort of when it about Switzerland and the Swiss banking industry sort of have this picture, very, very conservative, doing nothing out of the ordinary. But there it's been quite the opposite. I think it's quite a lively space. We see a lot of interest. We see a lot of talks happening with people in that area. So that's particularly interesting.
That's interesting. What do you think that is? Yeah, what do you think that is with Switzerland?
Maybe one of the reasons is that there are so many family offices around. There's so much, old money that's been around forever, and maybe there is then an interest in finding these sort of diversifying things. But yeah, I don't really have a good answer for it. But I mean, there is also where we see, basically banks popping up these days that are 100% digital based as well. So which is just they completely new. They tend to be in that area. So it's I'm a little bit surprised, but that's the way it seems to be. But I'm guessing maybe it's the long tradition that they have in doing banking, in having family offices, in managing money. So maybe it's not such a big step then going into this brave new world of interesting opportunity.
So what type of data sets do you guys use? I mean, obviously, I'm sure you're looking at a lot of like historical pricing data, things like that. Do you guys use other data sets like beyond pricing data?
Yeah, I think in terms of it's something that is traditional, of course. I mean, all trend followers, and I think a lot of ones as well. I mean, it's quite obvious that it's price and volume data is the majority of it, especially when you do trend following, and in shorter term trend following, then that's it. All the fundamental data, things like that, or sentiment data that exists in the market. That yes, it probably helps you a little bit, but the first reaction is always in the market anyways, no matter what news comes out. I mean, the prices are the first to react, and we try to be experts in modeling the underlying pricing process and really pick up upon the action via that. But that being said, I mean, we do use fundamental data as well. We are using sentiment data, like I mentioned. We are collecting and we are analyzing, looking into a lot of different things on the alternative data side as well. On the equity side, obviously, all the fundamental data, all those kinds of data that you find from accounting and so on. I mean, there's a lot of interesting information there that you can utilize with the learning-based approach and help you in those positions. So that's of course the equity. We do use that kind of data quite a lot. But I would say still for us, I mean, 90% is price and volume, and then we try to model that. Of course, always sampling it down to a specific frequency, but then depending on the model, depending on the approach, depending on the set that you are targeting and the approach you use, I mean, it's always that resampled, obviously, to a specific frequency that specific model needs. Via that, then of course you get maybe those diversifying signals and diversifying approaches to just looking at daily data or 1 minute data or 60-minute bars and so on. But yeah, I mean, price data is still a big part of it. But maybe after all the recent data we looked at, I would probably say that these different kinds of sentiment data are the ones that seem to have a little bit predictive power, a little bit of alpha in them. Again, it's always difficult. If we have, looking at news data or news sentiments and things like that, and yeah, you can probably get a decent strategy, going long, going short, trend following based on sentiment. But then at the end of the day, you have to benchmark it, against any other trend following signal that you might have in your portfolio. And so far, it's very rare that we would have found something that would actually bring a lot of traditional alpha. Maybe if anything, maybe on the short side, that maybe you can find some of those crisis signals sometimes, and which is also helpful. The good thing is, of course, that on that side as well, there's a lot of data available. There are many new providers. Everything is sampled, everything is recorded, and it's very nice again as a quant. It's very nice to play around with these things to try, because again we have this very stimulated investment process, and it's very easy for us to plug these things in and see, okay, does it help? And it, of course, it always gives us new ideas to try something completely different out of the box as well. But it's if nothing else, it's very valuable from sort of this challenging yourself from that point of view. But yeah, it's so far we haven't really seen. There are those exotic markets, there are the markets after the data on that side as well that probably brings a little bit of diversification, maybe some alpha. But then if liquidity is not good or things like that, then we'd rather not go into that area. So in the space where we trade, I think a lot of the data is out there. Everybody's exposed to it. It feels like it's difficult as such to find something that maybe is not already used. So then I would say it's more the way that you approach it. It's more the way that you apply your methodologies, how you consume that data that brings you the edge. I think that's where we try to be.
Yeah, really good points. How long does it typically take? Like how long do you need to test strategy before you get comfortable with it? And what do investors expect? I'm sure like an investor would be like, oh, it's cool that you guys just tested that for a week. Like what do you guys kind of look at, like timeframes?
Yeah, it's well, there are two levels we can talk about here. One is, of course, if you talk about the new program. So if you put something together like we did many years ago, like on the equity side, sort of a program where you would invest in the leaders in the ESG space. So we were consuming a lot of data from equity data, fundamental data, price data, a lot of ESG data that you put that in the algorithm, and it spits out, a portfolio of sort of the ESG stars and so on. So then obviously you need to track that for quite some time before people might be willing to invest in it. If it's sort of like a new program, ideally you would have somebody to see it pretty quickly, so you get the track record, and then typically, of course, you would probably have to have 6, 12, 24 months of track record before anyone believes in it. So that's one thing. Of course, that's maybe the most difficult thing, trying to actually raise money for something that is new. Even if the idea is great, it has to have a decent or long enough track record, at least on paper. But more importantly, with real money, that's at least what we tend to hear from investors. Then, of course, if you look at the traditional programs that you now run on the crypto side or on the traditional side or on the equity side as well, I mean, when we work on a new submodel or a new idea, a new factor, then because that's basically what we do on a daily basis. We try to find new things to improve the overall performance and improve the overall programs. And so typically, it can be quite, due to the platform we have, depending on the idea, depending on how things work out, we can be quite quick from implementation or from idea to implementation. That typically doesn't take very long. Then we sit down regularly, of course, and meetings and discuss and evaluate these things. We have sort of the checklists on the new submodel things that it has to pass the different criteria. And if we're happy with that, we're happy with the logic, we're happy with the work we discuss, we do all the forecasting. Of course, not a lot is needed since everything, again, is run on the same platform. So it is quite bug-free and quite stable, typically from day one. So typically, if it passes all those first criteria, then we put it sort of in the watch list. Well, like I mentioned, we probably have 20, 30 models that are sort of in this watch list paper trading phase. And then we track those models for for quite some time. Of course, we try to backtest them on as much data as we have. We of course have a lot of ways of doing cross-validation, getting rid of any potential overfitting problems, all the traditional pitfalls that you have in your backtesting, of course, using as few parameters as possible. And of course, it depends a little bit. If it's a completely new approach, new machine learning approach, or something that we methodology that we're testing, then typically we are a bit more, conservative. Then we pay the trade-up model for a longer period of time before we consider, adding it to the line portfolio, so to speak. And this typically takes at least 6 months nowadays. The main reason being, of course, we already have quite a nice suite of submodels in there. So competition is quite big. There is no point in, if you are about 20-25 models, there's no point in adding another 20 models because it doesn't bring anything besides trading. So there is already quite a big competition to sort of get in the portfolio. Maybe on the digital side, it's maybe a little bit easier to find new ideas, new things. So then we might, and of course, things that is another factor that you take into consideration as well. Is of course, obviously, how often does the model trade? If it trades often, then of course the test period, backwards, but also walk forward of the sample, it can be a little bit shorter because you are quicker to get a certain degree of confidence in the model if it trades a lot. So there are of course statistical things that you can look at there as well. There are other formulas and benchmarks that how much data you need to see, how many trades, and so on for it to be sort of a valid new model. So it's a quite strict process from us as well. And then of course, again, the final test is always this portfolio fit. That's always going to be the trickiest one. Like I said, it's not necessarily one model with the highest sharp that will then make it to the portfolio at the end of the day. Typically, it will be in or around it at least, but it depends a lot on the competition, what kind of new unique element brings to the mix, how quick we are then to implement it. But today, I think we're in a luxurious position from that point of view that we can easily track it to 4 to 6 months. 6 months before we consider then adding live, and this is something that we always communicate to the investors. Of course, removing models, it's sort of part and parcel of what we do. So I think investors trust us to do that as as day-to-day business. But we always, in not so much maybe the monthly letters that we send out, they maybe speak more about what are the factors that are working, which kind of model types is in the baskets, and at least where does the return come from an attribution point of view, where do we see the risks. But then we always have these biannual newsletters that we send out, and there we always open up a little bit more, what are we doing on the research side? What are we looking to implement? What are the new models? What are we looking for? And so on. Just to keep investors as invested and interested as possible. And we try, as an emerging manager, of course, we try to be as transparent as possible. We have to be, we are happy to be. We try to open up about the approach. We try to explain, and all investors, if they want them, they have their own. We have a work-based platform as well, where you can get sort of your positions basically live, where you see all the attributions, you see how much risk is allocated to the different factors, and all this. Just to be as transparent as possible, which I think is really, really important. Unless if it's managed to come, of course, then the investors tend to have that information. But then maybe they want to know that why are we allocating to, for instance, why are we long the S&P at the moment? Then we can break it down into the factors that of the 10% of AUM that we are now long in S&P, so and so many percent come from this factor and from that factor and so on. And you can produce this nice waterfall chart, for instance, how it all sums up to the total position. So each of the things we of course try to break from line then as well. But yeah. So again, it varies a little bit in terms of the how long we track the models. But I would say today it's probably the 6 months, and even after they go live, we always have there's always sort of a discretionary filter, which is typically 100%. So which means that basically when the allocation algorithm allocates to an underlying model, it gets 100% of that allocation. But if there's a new model, we could set that vector of discretionary weights to 50%, for instance. If we just want to make sure that for the first weeks of trading, it doesn't do anything out of the ordinary, depending on the market environment and so on. So we always have that opportunity as well, but it's not necessarily always used, because we are quite confident when we get to that point that we want to introduce a new model.
Makes sense.
Ronnie, talk to us about AI. How do you guys look at AI in terms of I guess just as a really general statement, but are you guys kind of using this to help build out your models?
Yeah, so it's a little bit like I mentioned there briefly earlier on. So basically, from day one, this approach that we have it's always been what we call learning based, which means that we use machine learning in different ways and forms throughout everything we do. It's from the bottom layer, bottom up, but also specifically top down in the allocation layer. We also use a learning based methodology and allocation algorithm that we developed ourselves over the years. Of course, the degree of complexity tends to vary a little bit, from if you're looking at, the first dimension of momentum chasing model or chasing a momentum, for instance, you don't really need to use deep learning network to be able to capture that. I mean, maybe then some sort of non-linear kind of capturing, maybe a bit more efficient with slightly less features and so on. So basically the way you could basically do all that we do as well. You could just take all the factors and then train one gigantic neural network on it and hope for the best. And it might work well from time to time, but for us, it would bring that, it would reduce that transparency that we want. So we want to target specific behaviors in the market. So that's why we chose to, break it down into these two layers and then take the specific submodels or components instead and focus on specific things in the market. So basically it's a combination of a lot of mini networks working together or working on their own and spitting something out that is standardized at the top layer they can allocate to in a meaningful way. So from our point of view is if you look at the whole from top level, top down, if you look at it, it's AI basically. It's a learning based approach where it becomes very self-learning, optimizing of process, the whole approach. But like I said, we started in 2016. Not that many people were talking about AI back then. It started to come more and more. We in with the accredited program, we're talking about one of these. We were presenting at one of the AI conferences in Frankfurt. Unfortunately, it was online because it wasn't the COVID times or just after COVID. So we had sort of a little bit involved in that scheme, trying to mention a little bit that, hey, guys, this is actually what we are doing. And like I said, now it's almost flipped over to the other side, and now it's all AI. Everything is AI. Everybody's claiming to be doing AI. We're still doing the same thing that we always have been doing, and we're trying to say, okay, but this is the way we've been working all the time. Of course, we did come to a lot of good things as well, because there are a lot of new methodology and things that we can test, and then new approaches that we can probably utilize that we really didn't think of just because of the onslaught of these. Of course, the ChatGPT and the large language models and so on, they of course are maybe not useful in from an asset management point of view, but they do of course bring a lot of other nice features in terms of working efficiency, using them for building code in Python and things like that. So there are benefits to that as well from us, and that's maybe the new thing in terms of where we haven't really utilized AI before, and we're writing presentations or monthly reports or summaries and things like that. That all of the sudden you have somebody to do that for you, and which is great when you are only 4 people. So that's maybe where we are using AI or learning in a new way. But besides that, I would say that it's very much embedded in what we do. We keep on talking about learning and adaptivity. That's the phrases that we want to use, because still it's a little bit more targeted. It's a little bit breaking it down components and putting those components together. So it's quite transparent. We sort of get all the layers and nodes in shape. I was in Paris actually. I think it was in spring, and there was another asset manager presenting them as well. It's very mathematical, based on pointers like that. They had quite an interesting observation actually, that they were training the AI to do investment decisions, and the agents turn in specific behaviors or finding those in market and then trading them and so on. And what they found that of course it was very, very easy to overfit, which we all know. The signal to noise ratio is actually quite bad in financial industry. I think that's there's so much noise. That's the main issue. It's so easy to overfit things, especially a neural network person driven that, because there are so many features and parameters and the degrees of freedom that can introduce, which of course will not help you going forward. But what they found, getting back to them, is that they first trained the networks on Japanese haiku poems, which of course gets the house in order a little bit, and then took the models and traded them on, or retrained or calibrated and trading on the financial markets. They actually saw an improvement, which basically means that you have to, since the financial markets, they don't really tend to follow the rules. There's so much noise, but if you play sort of the language approach to it, because it's not that difficult to make a predict what's the next letter, what is the next word, things like that follows sort of some kind of normal form, so to speak. So that then that helps. You have to dumb it down a little bit. Maybe you have to remove that unnecessary noise, and I think that sort of describes what we are trying to do. What we have been trying to do from day one. We are sort of the Japanese haiku there in between. We are trying to dumb it down and get it, focused on the things that we want the focus to be on, and by doing that, we sort of get rid of the noise, we get rid of the chaos, and make something that is virtually unpredictable. We try to make it predictable. I mean, so again, it doesn't only relate up to AI, it relates all kinds of modeling. Quant modeling is directly as well. It's everybody can take a package and train it on data. Computers are available, software is available, and data is, the skill set or the edge comes from, knowing what to do. I mean, having that experience to know how do you apply these methodologies in the financial industry to make it worthwhile. I think a few years ago we saw similar to the digital side, but in the traditional side, we saw quite a lot of people coming from different disciplines, different areas, where they were experts in AI, coming into financial markets, with making big noise and trying to manage money with it, and it hasn't always worked out very well. And I think this is one of the reasons that it's very easy to underestimate the degree of noise in the markets. It's one thing to teach AI to play chess. That's not maybe that difficult either, because it's a closed form solution. There's only so many rules. The playing board is quite small. Or you can teach AI to park a car. That's not difficult either. There are always so many things that can go wrong. But in the financial markets, it tends to be an exponential amount of things that can go wrong. So
Balance variables.
Yeah, exactly. So I think that's where the edge comes in, knowing how to apply these methodologies. I think that's where the edge is, and having maybe the platform and the approach to do it.
Awesome. Well, Ronnie, we've been at it for a while. I have one last quick question for you, Phil. What advice would you give to somebody that's looking to start their own fund?
Don't do it. If I would have known when I started how much work it would be, I would never have done it. That's the truth. All seriousness. I mean, it's the issue I think maybe today is that the regulation is so rigid. I mean, there's so much work and energy going into the legal side of things, compliance, regulatory sides, and that tends to kill a lot of ideas. It tends to kill maybe a lot of startups as well. It's actually quite difficult to raise AUM when you're small before you get sort of that critical AUM. I think that is also maybe one of the reasons why we're seeing a lot of brain power going to these multi-managers or trading shop on kind of places over the recent years, especially the last couple of years, because they're multi-managers, they're really growing, and then of course it's very easy for them to hire teams, and you get an allocation, and you get to focus on the things that you know best, and you don't have to worry about all the other things. I think that has been a trend. Because I think one of the reasons is, well, the two reasons are basically what I just mentioned. It's the regulatory burden of starting something, and then it's difficult in raising AUM. But definitely, I mean, if you have a great idea, if you have a great system, trade the track record. If you have somebody to back it, start trading the client as soon as possible. The light track record always beats anything else. But it's, of course, you need to be well connected in terms of getting that seed money, the seed AUM, to get things up and running. It's easy to underestimate maybe the work involved. We definitely did. We were fortunate enough to have seed investors from day one, both in the company that's a working capital and then also the institution that went in and seeded the fund, so we could get things up and running. But it was tough in the beginning. I remember we were small, I think 15 million USD, I think we had from day one. So it took the seed to take forever to get to that first 20, 30, 50, 100, 200. And now, of course, and the other thing is that always when you reach one milestone, you always want to reach the next, because there's always the next investor group that you want to target. Then you need to be at least 1 million, or then you need to be 5 million. So it's a never ending one. So I think for me personally, I think for our team as well there, I mean, yes, it's been tough. It's been a lot of work, but of course, at the end of the day, you wouldn't change it for anything else. Maybe I couldn't imagine, sitting at the desk and just working, alone, as a normal quant somewhere day up and be share. Yes, there's a lot of work, there's a lot of different things, but that also brings, it stimulates you. It's on a daily basis. There's so many things that you can work on. Of course, the flip side is that you never get anything done and you never get anything finished. But you learn something new every day, and you get to do, of course, a lot of stuff, which of course then tends to lead to the fact that I would rather do nothing else than just sit and code and just focus on that. And it's very rare that I get to do that nowadays. You have to be a little bit crazy, I think, to do this. But it's definitely a venture worth trying if you are lucky enough to be able to start. Then just start. I mean, you can always, if your track record is good enough, you will get money, and if nothing else, then the multi-manager shop will pick you up. So it's definitely do it. It's a lot of work. Don't underestimate it, but do it.
Awesome. Love it. Ronnie, this has been a lot of fun. Appreciate the advice as well there at the end. Where could people go to connect with you and learn more about Geneo Capital?
Well, they can always go to the webpage, of course, geneocapital.com. I'm also on LinkedIn. They could find me there. Always shoot me an email at Ronnie@geneocapital.com. We are easily accessible. We do get a lot of interaction from all kinds of people, traders, asset managers that are looking for a job, that have strategies, and investors that want to invest. I mean, on the webpage, there are ways to contact us as well. And I mean, we are open to discussing almost anything, as you should be when you're a small manager. And we very much appreciate people reaching out, because it makes our job a lot easier as well. So don't hesitate. We are easily accessible.
Awesome. This has been great, Ronnie. We'll make sure to include all that in the show notes as well.